Your tax refund is costing you $372,000. Not a typo. The money you celebrate getting back every spring is money you lent the government for free, all year, while it could have been compounding in the market. Most people think a big tax refund is a good thing. They treat it like a bonus. They use it to pay off credit cards, take a vacation, or put it in savings. But a refund is not a gift. It's your own money being returned to you, months late, with zero interest. In this video I'll show you exactly how your tax refund is built, why the average person loses $372,000 over 30 years, how to adjust your withholding in 10 minutes, and where to invest the difference so your money works for you instead of the IRS. If you get a tax refund every year, this video will save you more than your next raise. Let's start. Let's start with what a tax refund actually is. When you start a job, you fill out a form called the W-4. This form tells your employer how much federal income tax to withhold from each paycheck. Your employer sends that money to the IRS on your behalf. At the end of the year, you file your tax return. If your total tax is less than what was withheld, you get a refund. If it's more, you owe money. A refund means you overpaid. You gave the government more than you owed. They held your money for the entire year and returned it months later with zero interest. You didn't earn a penny on it. Here's the scale. The average tax refund in the US is about $3,000. That means the average person overpaid $250 every month. $250 that could have been in their paycheck, earning, investing, compounding. Instead, it sat with the IRS, doing nothing. Think about it differently. If you walked into a bank and said, "I'd like to give you $250 every month, hold it for a year, and give it back to me next April with no interest," they'd think you were crazy. But that's exactly what a tax refund is. You're doing it with the federal government. Now let's do the math. This is where it gets painful. $250 a month. That's what the average person overpays in taxes. If you invested that $250 every month at an 8% average return for 30 years, here's what happens. 8% is the long-term average return of the US stock market. Not a prediction. Not a best-case scenario. The historical average over the last 100 years. $250 a month at 8% for 30 years, with monthly compounding, becomes $372,000. That's not the 250 times 12 times 30, which would be 90,000. That's the 372,000 your money earns in compound growth on top of what you put in. You overpaid $90,000 total. You lost $282,000 in growth. Total cost, $372,000. And if you extend it to 35 years, the number becomes $572,000. 5 more years, $200,000 more dollars. That's the power of compound interest. Every year you delay, the cost grows exponentially. Here's the brutal part. The IRS doesn't invest your overpayment. They hold it. They use it. They return it to you at par, with zero interest, in April. Your money lost an entire year of compounding. Every year. For 30 years. A lot of people defend big refunds. Let me address the 3 most common arguments. Argument 1. I use the refund as forced savings. If I don't see the money, I won't spend it. Here's the problem. You're using the IRS as a savings account that pays 0% interest. You could set up an automatic transfer to a brokerage account for the same $250 a month. Same effect. You never see the money. But instead of 0%, it earns 8%. The forced savings argument costs you $372,000. Argument 2. I don't trust the market, so at least the refund is safe. Inflation averages 3% a year. Your refund loses 3% of its value every year it sits with the IRS. Over 12 months, your $3,000 refund is worth about $91 less in real purchasing power. You're not just losing investment returns. You're losing to inflation while your money sits there. Argument 3. I might owe money if I adjust my withholding. This is the fear of underpaying. The IRS expects you to pay at least 90% of your tax liability during the year, or face an underpayment penalty. But the IRS also provides a safe harbor. If you owe less than $1,000 at tax time, there's no penalty. The W-4 calculator on the IRS website walks you through this. It takes 5 minutes. You won't accidentally owe a fortune. Now let's fix it. Here's how to adjust your withholding in 10 minutes. Step 1. Find your most recent pay stub. Note how much federal income tax was withheld this period. Multiply it by the number of pay periods in a year to estimate your total annual withholding. Step 2. Estimate your total tax for the year. If you earned roughly the same as last year, look at line 24 on last year's tax return. That's your total tax. Add or subtract for any changes in income. Step 3. Go to your employer's payroll portal. This might be Workday, ADP, Paychex, Gusto, or your company's internal system. Search for W-4 or tax withholding form. Step 4. Increase your allowances or reduce the additional withholding amount. The goal is to have your withholding match your actual tax liability. If you got a $3,000 refund, you want to reduce withholding by $250 per month. On a semi-monthly paycheck, that's about $125 per check. Step 5. Use the IRS withholding estimator. Search IRS withholding calculator. Enter your income, filing status, and current withholding. It tells you exactly what to put on your W-4. Step 6. Submit the form. Your employer must implement the change by the next pay period. You'll see the difference in your next paycheck. Now you have $250 extra in your paycheck every month. Don't spend it. Invest it automatically. Step 1. Open a free brokerage account at Vanguard, Fidelity, or Schwab. All three have zero account fees and zero minimums. Step 2. Set up an automatic transfer from your checking account to your brokerage account for $250 on payday. This is critical. If the money sits in your checking account, you will spend it. Automate it. Step 3. Buy a total market index fund. At Vanguard, that's VTI, expense ratio 0.03%. At Fidelity, it's FSKX at 0.015%. At Schwab, it's SCHB at 0.03%. All three track the total U.S. stock market. Step 4. Set it and forget it. Don't check it every day. Don't sell when the market drops. The 8% average return includes down years. The compounding happens over decades, not months. The total cost of managing your own portfolio, 0.03%. On a $372,000 portfolio, that's $112 a year. No advisor fee. No management fee. Your money works for you, not for someone else. Here's the action list. 10 minutes. $372,000. 1. Check your last tax refund. If it was over $500, you're overpaying. 2. Go to your payroll portal and update your W-4. Use the IRS withholding estimator to get the number right. 3. Open a free brokerage account at Vanguard, Fidelity, or Schwab. 4. Set up an automatic transfer for the amount you were overpaying. $250 a month. On payday. No thinking required. 5. Buy a total market index fund. VTI, FSKX, or SCHB. Expense ratio 0.03% or less. 6. Never touch it. Let it compound for 30 years. That's your $372,000. The short version of this is pinned on the channel. Follow for one money rule a day. No hype. Just math.